Imagine a company that looks wildly profitable on paper, but is actually bleeding cash behind the scenes. How is that even possible? The answer lies in something most people never think about: the adjustment process. And by the end of this video, you will know exactly how it works. Welcome back. Today we are breaking down one of the most important and most misunderstood parts of financial accounting: the adjustment process. We will cover what adjusting entries are, why they exist, the four main types, how they affect your financial statements, and what an adjusted trial balance actually looks like. Stick around, because this stuff is the difference between financial statements that tell the truth and ones that are dangerously misleading. Section 1. Why adjustments exist. Here's the core problem. Businesses operate continuously. Money flows in and out every single day. But financial statements are prepared at specific points in time: the end of a month, a quarter, a year. So how do you capture everything that happened in that period accurately? That is where the accrual basis of accounting comes in. Under accrual accounting, revenues are recorded when they are earned, not necessarily when cash is received. Expenses are recorded when they are incurred, not necessarily when cash is paid. This sounds simple, but it creates a timing problem. Some transactions span multiple accounting periods, and without adjustments, your books will not reflect reality. Think about it this way. A company pays 12 months of insurance in January. One lump sum. Should all of that show up as an expense in January alone? Absolutely not. Each month only uses 1/12 of that insurance. Without an adjusting entry, January looks catastrophically expensive, and every other month looks free. That is not accurate. That is not useful. And that is exactly why adjustments exist. So here's the question that should be on your mind right now. What are the actual categories of adjustments we need to make? Section 2. Deferrals. Prepaid expenses and unearned revenue. The first big category is called deferrals. A deferral happens when cash changes hands before the revenue is earned or the expense is used. There are two types: prepaid expenses and unearned revenue. Prepaid expenses are things a company pays for in advance. That insurance example, that is a prepaid expense. When you first pay it, you record it as an asset because you have not used it yet. But as time passes and you use up that coverage, you need to move a portion from the asset account into an expense account. That is your adjusting entry. Same logic applies to prepaid rent, prepaid supplies, and similar items. Unearned revenue works in the opposite direction. This is when a customer pays you before you actually deliver the goods or services. A magazine subscription is a classic example. A customer pays for a full year up front. At that moment, you owe them 12 months of magazines. That cash is a liability, not revenue, because you've not earned it yet. Each month, as you deliver the magazine, you convert a portion of that liability into actual revenue. That conversion? That is your adjusting entry. Both of these adjustments make sure your financial statements reflect what actually happened in the period, not just when cash moved. But deferrals are only half the story. What about things you have already used or earned, but no cash has moved yet at all? Section 3. Accruals, accrued revenues, and accrued expenses. This is where accruals come in. Accruals are the flip side of deferrals. An accrual happens when the economic activity has occurred, but the cash transaction has not happened yet. Accrued expenses are costs a company has incurred but not yet paid. Employee salaries are the most common example. If your accounting period ends on a Wednesday but payday is Friday, your employees have already earned 2 days of wages. That is an expense that belongs in this period even though the check has not been written. The adjusting entry records that liability now so the expense shows up in the right period. Accrued revenues are the opposite. These are revenues a company has earned but not yet received cash for. Say a consulting firm completes a project on December 28th, but sends the invoice on January 5th. That revenue was earned in December. If no adjustment is made, December's income statement will look weaker than it actually was, and January's will look stronger. The adjusting entry fixes that by recording the revenue and a corresponding receivable in December, where it belongs. Accruals are arguably the most powerful category of adjustments because they reveal the true financial picture, even when cash has not moved. Now let us talk about one more concept that touches almost every business: depreciation. Section 4. Depreciation. Long-term assets like equipment, vehicles, and buildings get used up over time. But unlike supplies you throw away after one use, these assets last for years. Depreciation is how accounting handles that gradual consumption. Here is the key idea. When a company buys a delivery truck for $50,000, that truck does not become an instant expense. It will be used over many years, so its cost should be spread across those years proportionally. Each period, an adjusting entry is made to record depreciation expense, the portion of the asset's value used up in that time frame. The entry credits a special account called accumulated depreciation, which is a contra-asset account. That means it sits on the balance sheet right next to the asset, but reduces its book value. The original cost stays visible, but you can also see how much has been used up. This transparency is extremely valuable. And here is something that surprises a lot of people. Depreciation is a non-cash expense. No cash leaves the company when you record depreciation. It is purely an accounting recognition of the asset being used. That is why depreciation shows up as an add-back when companies calculate cash flow. Pretty interesting, right? But how do all these entries come together before the financial statements are prepared? Section 5. The adjusted trial balance. Once all adjusting entries have been recorded and posted to the general ledger, it is time to prepare an adjusted trial balance. Think of this as a refreshed snapshot of every account balance in the system after all the corrections have been made. The unadjusted trial balance shows balances before adjustments. The adjusted trial balance shows balances after. The difference between them reveals the total impact of your adjusting entries, and it is the foundation for preparing accurate financial statements. From the adjusted trial balance, accountants pull the numbers they need for the income statement, the statement of retained earnings, and the balance sheet. Without it, those statements would reflect an incomplete and distorted picture of the company's financial health. The adjustment process is not just a technical formality. It is what makes financial accounting reliable and meaningful. It is what ensures that the numbers investors, managers, and lenders look at actually reflect reality. Here is your challenge. Think of a business you interact with regularly, maybe a gym, a streaming service, or a contractor. Can you identify one situation where they would need to record an adjusting entry? Drop your answer in the comments below. I would love to see what you come up with. If this video helped you understand the adjustment process, give it a like so more people can find it. Subscribe if you want to keep building your accounting knowledge one chapter at a time. And check out the next video, where we dive into the financial statements that come directly out of this process. See you there.